Okay, hi, my name is Jordan Thomas.
Hello everyone, my name is Christian Cornejo,
Mia Lee.
I'm Jason Denkel.
and today we'll be discussing publicly traded partnerships.
Alright, hello everyone. So today's agenda is we're going to start off with an introduction, and then we're going to discuss the definition and the structure of a publicly traded partnership, and then discuss some benefits and drawbacks of investing in a publicly traded partnership, as well as walk through a K1 and end it with a summary and an open-ended question and answers. Alright, so an introduction to a publicly traded partnership essentially is just an entity with two or more co-owners, and their stocks are publicly traded in a securities and exchange market, as well as they're managed by two or more general partners who can be an individual, a corporation, or another partnership. And as well, they can have limited partners who invest capital, and however, they do not enjoy any management responsibilities. And they also enjoy some tax benefits that limited partnerships receive, while also enjoying the liquidity of publicly traded stocks.
When someone buys a PTP, they are considered a limited partner in a master limited partnership. When investing in a PTP, instead of buying a share, the investor would purchase a unit, which is a percentage of interest. These units are sold on public stock exchanges. This gives investors the ability to buy and sell units with unique simplicity as compared to other partnerships. Many PTPs are set up by integrated oil and gas companies like Cheniere Energy. These corporations do this because they believe a portion of their assets are not properly reflected in their stock price. First, the corporation registers a spin-off master limited partnership with the SEC. Then the corporation sells its assets to the partnership. These assets usually comprise of midstream pipelines. As a result of this transaction, the company owns a large stake in its spin-off partnership. The PTPs are seen as a collection of partners rather than a separate legal entity. One significant limitation of PTPs is that 90% of their income must be considered qualified income. Qualified income can be in the form of passive, through interest, dividends, and rent, and non-passive in the form of exploration, development, mining, refining, marketing, and transportation.
Today we're going to discuss about the benefits and drawbacks of investing in a public trade partnership unit, a PTP unit. A PTP unit is equivalent to a public trade corporation stock, and so you might wonder what is the most recognized benefits of investing in PTP units. Will you be surprised or excited to see that your annual stock is yielding 10% annually? Yes, and this is the main reason why PTP unit is superior to publicly traded corporation stocks. So what makes it so appealing is the chance for a return far in excess of the broader market generally. For example, in 2019, the PTP, a public trade company, yield about 5% on average. In rare case, some PTP yields have a double-digit yields of more than 10%. Compare that to the S&P 500 index of 2% average yield. The public trade partnership outperforming public trade corporation, obviously. Another benefit of investing in PTP unit is tax special treatment. The first advantage of tax advantage is why it's a corporation. It has the liquidity of a public trade corporation. A PTP is treated as a limited partner for tax return. That means that all losses and income are passed through to the limited partner levels. Compared to a corporation, double taxation of being taxed at corporate level and at the ownership level, a PTP is all of the public trade partnership income are passed through to its level, but to its partner. So resulting in a single layer of U.S. federal income tax. So another tax benefit of investing in PTP unit is tax shield. And this is an example of how tax shield works. So if investor expected dividend is $100, his expected share of PTP taxable income is $15, which is 15% of the expected distribution. Then the portion of his dividend that are taxable currently would be $15. The rest of them, $85, would be classified as a return of capital. And tax on return of capitals are not owed until the PTP unit is sold. So resulting in deferral of income as long as the investor basis is still more than the distribution. This special tax treatment explains why the IRS limited to the PTP qualification only to certain type of business, namely real estate and midstream energy sectors. The midstream sector mainly involve the company that involve in the transportation, either by pipeline, oil tanker or trucks, of crude or refined petroleum products. Therefore, the majority of PTPs are pipeline companies.
While there are many advantages to publicly traded partnerships, there are also several drawbacks that needed to be pointed out. So first, the financial information burden. Every PTP needs a financial advisor to keep track of the extensive K-1s that can get pretty detailed. Secondly, there are less short-term capital gains for investors, as well as the issue of the lack of foreign investors. For example, Blackstone Corporation began as a PTP but was unable to raise enough capital since foreign investors are unable to own any interest in a publicly traded partnership, so they had to switch from a PTP to a corporation. Lastly, there is a passive loss limitation, which means that unlike a traditional flow-through partnership, these passive losses can only be offset by earnings from the same entity or the same PTP.
A good example of the kind of tax documents an investor would receive is My K1 from Enterprise Products Partners. As you can see with the image on the left, it shows the list of transactions that took place in 2018. In May, I purchased 2 units, and then in June, I purchased another 2 units. The middle image shows a list of descriptions that are important having to do with the investment, specifically the estimated tax basis of 102, which must be tracked. Another good item is the 199A and the passive activity losses. Now on the right, this is the very important document, the K1, which must be reported. It shows ordinary income of -5, distributions of 4, as well as being on the tax basis accounting method. I would encourage everyone that when you're investing to check out PTPs, especially if you're an investor that's looking for cash flow in the form of dividends or distributions. I think they're one of the best investments. This year alone, I've purchased already a few hundred more shares.
So in summary, we have discussed the publicly traded partnerships 90% requirement of income, which must be from qualifying sources as outlined by the IRS. We also discussed how their PTPs are similar to master traded partnerships, and as well discussed the benefits like high dividend yields, tax savings, diversification, more structured asset management. Some of the drawbacks with the publicly traded partnerships that we discussed is the financial information burden that comes with records management, unpopular with investors who are interested in short-term capital gains, and also passive losses are capped. And we also discussed a sample K1 where we walked through all the activities that occur with the publicly traded partnership.
A quick question and answer exercise. So question number 1, what is Enterprise Products Partner ELP's 2019 dividend yield? If you remember from the beginning of the presentation, the answer is 6.4%. And the second question is, how does a PTP shield its investors from paying tax on dividends? The answer to that is a portion of the dividends are treated as a return of capital, and thus the tax is deferred until liquidation of the PTP.